Hi. Good morning, everyone.
Good morning. Good morning.
Thank you for taking the time out of your Saturday morning to join us here to learn, I guess, everything you want to learn about taxes and more. Before I go ahead and get started today, obviously we're here to learn about the Tax Reformed Act. But, one thing I want to just make clear, I'm sure a lot of you are probably in the stages of getting your 2017 tax returns prepared. So keep in mind that a lot of what we do talk about today is not going to apply to your 2017 return. Okay, those are under the old laws. What we're going to be talking today about is what applies as of 2018 moving forward. So you'll want to take into account as you kind of plan for your year, thinking about how these tax laws affect you. Okay? So just a little bit of background on the Tax Reform Act. House and Senate bill did have their own versions of the bill, and then eventually they did come together as a committee and finalize the bill. A lot of these provisions are going to sunset in 2025, which means that if a new bill is not enacted, it will go back to the 2017 tax rules. Okay? Trump signed this into effect, effective January 2018. Okay? So we're really going to talk about three categories of individuals. We're going to talk about, there's a lot in the Tax Reform Act, but really we're going to focus on how does it affect you as home. The effect on single filers, essentially unmarried individuals. This does not apply to head of households who have dependents in their home. But essentially what you're seeing here, and I've highlighted in yellow, is how it affects a taxpayer in the approximately what we call the prior law, 2017 law, in the 93 to 195 tax bracket. What we're seeing is a change in the tax rate of about 4%. So overall, what we think overall is this has been a great thing for tax filers because you're going to see your tax rates on average decrease about 4%. So what that means is, let's say you're in a $100,000 tax bracket, you're probably going to see a marginal decrease in taxes of about $4,000 just as a result of the tax bill. Okay, so that's a good thing for people. People are seeing decreases in the taxes they are paying. Next one is kind of similar to what we have for single filers. This applies for married filing jointly. For those of you that are married, these are going to be your new tax brackets as of 2018. So those falling in between, for example, 165 and 315. Again, you're going to see about a 4% marginal decrease in taxes. Now, there are other tax rates that do apply to head of households. I haven't gone into those, but keep in mind overall, the tax bill is decreasing the marginal tax rates for these individuals. Okay, this is kind of a big area. So maybe if I could get a show of hands of how many of you here are homeowners? Okay, so we have a good majority, so you really want to pay attention to how this affects you. Okay, there are really some big changes on what can you deduct for mortgage interest. Okay, so this is the mortgage interest that you're paying on your home loan. Okay, this does not apply to rental or investment properties. There are a bunch of separate rules that apply to rentals. This really applies to your principal residence. Okay, so what are the grandfathered rules? So what that means is under the old law, for all of you individuals that have less than $1 million, probably not affecting Sacramento so much, maybe more coastal homes or Bay Area, but for anyone who has less than $1 million in home loans, you are still allowed to fully deduct that mortgage interest. Okay? If you refinanced, it had to be before December 14th. Again, it's $1 million cap, fully deductible mortgage interest. Okay? What's happening now, so we had a lot of individuals, so let me give you an example. I have a client who, on December 25th, before year end, went ahead and purchased a home. and they purchased a home for $1 million, and they thought that this new rule wasn't going to apply till January of 2018. They took out a loan for $900,000 and purchased the home. And then they found out, after they had purchased the home, that they could only deduct $750,000. So there was going to be $150,000 of their loan that is now non-deductible. Okay? Again, a lot of this is probably not going to apply to individuals here, but I think the thing that I want you to take away from this presentation is if you have existing mortgage loans on your home, you need to really think about if you're going to refinance and pull out cash. Okay, because a lot of people will refinance, and maybe they want to pull out an additional $50,000, and they want to buy a car, or they want to buy a boat or vacation, whatever it may be. That extra cash that you're pulling out that is not used for improving the home will be non-deductible. Okay? That really brings us to home equity debt. This is a big provision that a lot of people aren't particularly happy about. So what that is second loans on your home. Okay, so if you've taken out a second loan on your home and it was not used to purchase the home, or it wasn't used to improve the home, whether it be putting maybe a swimming pool in or landscaping your yard, if it was taken out for something unrelated to the home, even though you have that loan on your house right now, it is non-deductible. Okay, that's a big thing. People are like, but I've always deducted that on my return. It is now non-deductible. You will not be able to deduct that on your 18 returns. Okay, for 17, you still can do that. But once 18 comes around and you still have that loan on your home, it is non-deductible until 2025, which is what we call the sunset provision. If you still have that loan in 2025, you can start deducting it again. Okay, another big change is a deduction for property taxes and state and local income taxes. Now, this is really going to apply for those of you that itemize your deductions. So if you do not itemize your deductions and take the standard deduction, then this is not really going to apply to you. We're going to talk a little bit later about standard deductions, but what this is so for those of you that have a house, those of you that pay property taxes, and those of you that pay state taxes to the Franchise Tax Board through like your W-2 withholdings or estimated taxes. So for example, I have a client who has about $10,000 in state income taxes that they pay to the Franchise Tax Board, and they pay about $5,000 in property taxes on their home. So they have a $15,000 itemized deduction on their return, and that's in 2017. They'll be able to take that in 2017, but now moving to 2018, it is capped at $10,000. Okay? So if you're paying state income taxes of 10 and property taxes of 5, you don't get to take that 15 anymore. You only get to take a maximum of 10. Okay? So they're limiting it to 10,000. And like I said, prior law, you could deduct the entire 15. Okay. Next one is exemptions and standard deduction. So there's been a couple of changes. So for those of you that do not itemize, these are the standard deductions that you're going to take on your 2017 return. So let's just take a married individual. 2017 standard deduction. They are not itemizing, which means they don't have property taxes, they don't have mortgage, they don't have charitable contributions, they don't have car registration. They're not deducting any of that. They're just taking this $12,700. Okay? In 18, that is going to double to 24. Huge benefit for those that are taking the standard deduction. Okay? On average, what we're saying is that is probably equivalent between $2,000 to $3,000 in less taxes paid if you're going to double your deduction from 12 to 24. Okay, that's for those taking the standard deduction. Those tend to apply more towards people who maybe are renting, or maybe people who don't have a very high mortgage, and so they're taking the standard deduction because they just don't have enough deductions. Okay? But one of the flip sides where I think those of you that are itemizing really need to consider is what this is going to do to you. Because what we're seeing now is because of the changes in the tax law, a lot of people, almost 80% of Americans, are no longer going to be itemizing. Okay? Which means it's great from the benefit of less administrative burden. You're not going to have to gather your car registration, your mortgage interest, your property taxes, your charitable contributions, looking for all those goodwill receipts when you go and bring all those donations and all those little pieces of papers that I get. Well, how would I know if I should be itemizing or taking this $24,000 deduction as a married individual? And so yes, I think you do need to look at what your itemized deductions will be. But what we already know is because you're maxed out at the $10,000 for property taxes and state and local taxes, that means you only have a $14,000 deduction for your mortgage interest. So if your mortgage interest is less than $14,000, then you're probably going to go this way. And so what we've done is we've calculated at what amount of your loan will you more than likely take this standard deduction. And so what we've done is we've done an analysis and said, if your loan is less than $350,000, you're more than likely not going to itemize. Okay? The only difference where that might make a difference is if you are in a over $200,000 tax bracket, because you're paying a lot more state income taxes. But on average, if you have a mortgage home loan of less than $350,000, we're thinking that your mortgage interest, your property taxes, your state income taxes, your charitable contributions are probably going to be less than 24. Okay, a couple of other deductions, credits, and miscellaneous changes. So these are, again, some of the itemized deductions that people are taking. What we're saying is that with medical expenses right now, if you have medical expenses over 10% of your income, they are deductible. The benefit is they've dropped that down to 7.5%. So, you know, we're really talking about major medical expenses. If you make $100,000, the first $7,500 is non-deductible. Anything over and above that first $7,500 you can deduct on your return for 17 and 18. And then it goes back to 10% in 19. Charitable contributions. So again, a lot of people are not going to be itemizing anymore. So what does that mean? Do I really want to start making charitable contributions? Because I'm taking the standard deduction, I'm not getting a benefit. And so what we've seen as a result of this Tax Reform Act is less people are being charitable. Because they're like, well, unless you really have that heart to be philanthropic, the idea is that this has really hurt charities. Because if I'm not itemizing anymore, I am not being able to deduct them. Okay? Now, what we've told a lot of people, so I represent a lot of clients who donate heavily to their church, and they're going to continue to do it irrespective of the tax laws. So what we've talked to clients about is what we call stacking, or donor advised funds. So what we tell them to do is that if you're going to make a donation, make that donation in December so that it kind of stacks for both 2 years. So you're essentially stacking your contributions into 1 year so you can itemize. Okay. The other option, which has been really good for investment houses like Charles Schwab, Fidelity, is these donor advised funds. What that essentially is you're putting money into what's called a donor advised fund. It's a charitable contribution. You put it into the donor advised fund that's managed by an investment house, and then you have a window of time to make those contributions over time, but you're getting that deduction in the year in which you put it into the fund. So stacking is, the idea is, so let's say you're contributing to your church and you're giving, let's just say, I'm giving you an example. What's that? 10%. 10, okay, with the tithing, right? Yeah. Okay, so let's just say you're a $100,000 taxpayer and you're giving $10,000 to your church. Yeah. So the idea is you're just going to save that. You're just, going to put it into an account. You're going to save it, and in December, you're going to try to make those contributions either into a donor advised fund or into a directly, but you're going to stack all those contributions for 17 and 18 in 1 year because you're going to make that contribution. So a lot of people will sometimes take it out of their IRA and just put it into the donor advised fund and from there contribute, because there are no penalties when it comes from retirement. There are some creative rules where you can donate from retirement accounts. So the question was, what is a donor advised fund? This is a concept that has been around a really long time, but has only really traditionally been used by the super ultra wealthy. But it has become more of a way of making charitable contributions because they're now becoming non-deductible to those that take the standard deduction. So it's becoming more of an idea for people to make charitable contributions and be able to take the deduction in the year in which that contribution is made into that fund. So let's say you have a Fidelity account and you open it up and say, you know what, I want to donate money to my church, but it's going to be non-deductible on my return this year because I don't itemize. So people will put their charitable contribution into this donor advised fund, which is a lot like what you think about, like mutual funds, things like that. And then from that donor advised fund, over a period of time, you make your contributions to charity, but you get the deduction in the year in which you put it in the fund.
So the fund will distribute the money to the church?
Yes. You tell them where you want it to go. SPCA, your church, Goodwill, whatever it is. Yeah.
Is that part of a bank?
It's part of an investment brokerage house, so you're thinking like Fidelity, Charles Schwab, a lot of these houses that do stock and investment accounts.
It's a product of these houses.
Yes. Yeah, and they specifically are designed for charitable contributions. Mm-hmm. Oh, okay, so your question was how she's looking at it and saying, oh, you don't have enough charitable contributions. How do you know that I can't take that as a deduction?
I mean, whether it's $1 or $5,000, I mean, you still should take that into consideration.
Yes, it should still be factored in. She should be doing a high-level analysis to see if it's deductible or not. Do you itemize?
She doesn't even like to itemize.
Are you saying your tax person doesn't itemize because you're saying there's not enough there to itemize?
Well, I guess. I mean,
whether it's true or not.
Well, $5,000 is $5,000.
Absolutely.
No.
Well, it's hard to say because if we go back to...
No.
Are you single or married?
Married.
Okay. So you would get $12,700 in standard deduction on your 17 return. So if you have mortgage, property taxes, charitable contributions, car registration, unreimbursed work expenses, tax preparation fees, if that's more than $12,700, then you would be itemizing.
That's what I'm saying.
Yeah.
I didn't even know that.
Yeah.
We have Irene's card.
Yeah. And one of the things I think people need to keep in mind is, with the clients that I work with, we are not really in the business of just preparing a return. I mean, I know a lot of people will go to the H&R Blocks or the smaller CPAs, and they'll just going to take your information, whatever you give them, they're going to plop it down and be done. Our firm really specializes in, hey, this tax return needs to be done. It's kind of a necessary evil. but we really focus on tax planning, meeting with the clients at the beginning of the tax year, kind of going over their life plan and coming up with a plan for them so they can carry it out through the year to maximize and minimize their taxes. So we talk about, okay, this is what you have, this is what we think you can do to maximize those deductions. So in the end, our clients are really, really happy because the tax fee that they pay us, probably we've saved them more money than what they've paid us. Okay, so if they pay us, I'm giving you an example, $500 for a tax return, we've maybe saved them $2,000 with all these different ideas we've given them. Okay, a couple of other things I just wanted to mention real quickly. 2018 miscellaneous itemized deductions. These are for people who are W-2 workers. Things that you're not reimbursed for. Let's say you're using your cell phone for work, you're doing mileage, you're going somewhere for work-wise, you're not being reimbursed by your employer. You have union dues, anything related to unreimbursed work expenses, tax preparation fees, things like that, they are all non-deductible now. Okay. Child tax credit. For those that if you have children under the age of 17, the biggest benefit you're going to see is an additional child tax credit. So it's good to have kids. Okay, the child tax credit is $1,000 right now. It's going to go up to $2,000 per child. That is a dollar for dollar reduction in your taxes. Huge, huge benefit for those with kids. Do the happy dance, right? Well, but you probably have a lot of tuition credits, college educational credits you can take advantage of if you have kids in college. I didn't cover that in this seminar, but if you have kids in college, there's some benefits you're going to get out of that.
Oh my God, and he graduated.
Okay, 529 plans. These are those ones that are setting up college plans for their kids. Traditionally, historically, it's only been used for college. They've now opened it up. You can use it for private school and K through 12 education. 529 money is where you're putting money aside for college, for your kids' college. And so when they withdraw the money, it's tax-free. You don't have to pay taxes on it. So it's a vehicle that a lot of parents and grandparents use to help save money for their kids or grandchildren for college.
Does it have to be locked into something like a CD or an annuity? It can be just a regular savings?
It can be, so long as it's locked in a 529, it can be in cash, it can be in marketable securities, mutual funds. It's your choice as to what you want to invest the 529 in. Okay, moving expenses. These are for people who are moving because they're changing or relocating for job purposes. So let's say you work in Sacramento and you've got this great opportunity with your same company down in LA. Okay, and you have all these moving expenses that you're incurring to move all your personal possessions down there. Okay, in 2017 and prior, you could deduct those moving expenses on your return. So that was a good benefit. Moving forward in 2018, unless you're in the military, sorry, no longer deductible. Okay. Also, if let's say your work is reimbursing you, we see this a lot with larger companies. They will say, we'll reimburse you, $10,000, and we'll give you $10,000 to move. If they give you $10,000 to move, that is now income to you.
For losing, yeah. It's like they lower taxes, but screws you in the end.
All right, so now we're moving out of the arena of individual taxes and moving into business returns or those involved in real estate investments. People who are either investors in real estate or people who are real estate professionals. 1031 exchanges. Anyone know and familiar with what that is? Anyone? Okay, looks like one person, so, okay, couple people. All right, well, let me just kind of briefly talk about what a 1031 is. A 1031 is when you have a piece of property and, maybe for some reason you want to sell it because maybe you just want to get out of that piece of property, but you still want to be invested in real estate. I'm thinking about selling this property because I'm not really happy with its performance. I'm going to spend a lot of money to fix it up, and I just have a lot of complaining tenants. Should I just go ahead and sell and just get out of the market? So where we would come in is say, well, you know what, if you sell, I think one of the things you need to think about is, you know, you might pay taxes on the sale because you bought it 10 years ago and it's increased in value. And if you sell it, you might have made $100,000, but you're going to pay $30,000 in taxes. And they're like, well, I don't want to do that. You know, I don't want to pay $30,000. I just want to get out of this property. So this is where 1031 comes into play. What happens is the real estate agent will sell that property and they will 1031 into a different piece of property. So you'll buy what's called replacement property. You know, you're buying property maybe that's in better condition, maybe is better for you because you know, the property doesn't have all these deferred maintenance. Now let me talk to you about Delaware statutory trusts. I think a lot of people don't know about these. This is not actually an investment in annuities, but what it is it's selling that first property and taking those proceeds and investing it in a DST. It is a type of real estate investment, kind of like REITs for any of you that know what real estate investment trusts are, but it's not a REIT. It's kind of what you want to think about as kind of a investment, like into stock or mutual fund, but you're not investing in stocks or mutual funds, you're investing in real estate. How do I protect myself? A lot of people have businesses. They are not incorporated as LLCs. We are recommending all real estate professionals, any business owners, you need to incorporate into an LLC, because if you do not and you get sued, they are going to be able to reach your personal assets. If you incorporate, they are only limited to what is in that LLC. They cannot touch your home, they cannot touch your retirement, they cannot touch your bank accounts.
What's an LLC?
An LLC is a limited liability company. You know, there's really a lot of planning that needs to go into in not paying taxes if you are going to be living in the home and then renting it out, or if you started it out as a rental and then moved into it. The rules get very complicated, and so you really need to seek tax advice whenever you have a home that has half use as your personal residence and use as a rental. The rules are very specific to your facts.